Well, what is happening to interest rates? The Reserve Bank cuts to its benchmark rate don't seem to have had an impact in terms of long-term rates. Now banks are raising their long-term fixed rates. The ANZ National Bank has followed Westpac, the ASB and BNZ yesterday in raising rates on 3, 4 and 5 year terms by up to 1/4 percentage point. Shorter-term interest rates such as the floating or 6-month fixed mortgage rates are expected to remain low as the recession continues. But what is happening to the longer-term rates that many people are hoping to set? Where does it leave the consumer? Will there be further increases to those longer-term rates? What should homeowners and potential new buyers do? To discuss this and the impact also on savers, joining us now is Bernard Hickey. He's the managing editor of interest rates monitoring website www.interestrate.co.nz. Good morning to you, Bernard.
Good morning.
So let's look at this. Some people have gone on to floating rates. Some have paid high break fees to do so, and they're waiting for a great rate to fix for a long term. Is this as good as those rates are going to get now?
I'm afraid it is. We've started to see in the last couple of weeks those 3, 4 and 5 year mortgage rates rise quite substantially. In fact, they started rising in mid-February. And that's because at the long end, at the 3, 4, 5 year end, the markets actually take a lot more notice of Barack Obama than they do of Alan Bollard. And because Obama is borrowing money heavily on international markets, and because central banks globally are printing money hand over fist, those long-term interest rates are rising on wholesale markets because investors believe inflation is rising and because they believe essentially that the value of their money has been devalued by all this money printing.
So do we believe the banks when they say that going out on the market to secure the cash that they then on-lend to us, do we believe them when the cost of doing that is going up?
Yes. Just yesterday, for example, the BNZ had to go out to raise 5 year money. Obviously, they raise it on markets and then they lend it on to us. They had to pay 6.15% at least for that money and are lending out their money on mortgage rates at about 6.7%. So that only gives them a margin of about 50 basis points, which is hardly anything really for a bank. And the banks are at the moment grappling with much higher funding costs internationally and are having to pass that on to us over the long run. It does mean, though, that people who thought they could wait for long-term fixed rates to keep falling should realise that that is over and they need to fix if they want to fix now, because those rates are going to keep rising over the next year or two.
They are still, around 6.5% or so, some options that are available?
Well, the 5 year rates are up now at 6.75%. And in fact, this morning we've just heard that Kiwibank has increased its 5 year fixed rate mortgage to 6.75% as well. Once you get to around about the 1-2 year mark, you're looking at around about 6%, and for floating rates around about 6 to 6.5%. So we're starting to see a situation now where, at least for the next 6 months or so, it's actually going to be cheaper for people in the short term to borrow either a very short fixed rate, so 6 months, or go to some sort of floating rate, which are likely actually to keep falling because the Reserve Bank is pretty much expected to cut the official cash rate again on April the 30th. That
said, they're nearing the bottom of their barrel. They've made that clear, the Reserve Bank.
Exactly. They can't cut too much more than about 2.5%, because if they tried to, they'd be essentially pushing on a string. The other thing which is restricting the banks and the Reserve Bank is that New Zealand's credit rating is under threat. And the Reserve Bank had hoped that our banks would be able to go out onto international markets and issue wholesale guaranteed bonds. So these are government guaranteed bonds. But they haven't been able to, quite surprisingly. They've had this ability since the end of last year. They haven't been able to in the last 3 months because international investors are worried about New Zealand's credit rating while there's this uncertainty at the moment, and that uncertainty is likely to stay until the government announces its budget in May. That means the banks can't raise money long-term on these wholesale markets. So they haven't actually go to mums and dads here in New Zealand and offer them quite high rates relative to the official cash rate.
What are the question marks over New Zealand's credit rating? You'd think, actually, given that we managed to stave off the worst of the financial crisis locally, that would be a factor. But is this simply a question of where our debt track may head?
That's right. I mean, the New Zealand government will have to borrow upwards of $50 billion in the next 3 to 4 years. And that is a problem because the private sector has been borrowing heavily over the last 5 to 10 years to fund this housing boom. And that was fine as long as our government had a good fiscal position and wasn't borrowing too much. So private dissaving, or borrow and spend, was offset by public sector saving. So we're running surpluses. So that was good news for the ratings agencies. But now that the government is heading heavily into deficit for a bunch of reasons, there was quite a lot of spending put in place by the previous government and agreed to by the new government, as well as the inevitable effects of a recession on GST receipts and corporate tax revenue receipts. The government's deficit is going to head quite a bit into the red in the next 3 or 4 years. And the key question that no doubt cabinet ministers are sitting on right now is how much can they afford to spend, and in fact how much will they have to cut to make sure New Zealand keeps its AA+ credit rating from Standard & Poor's.
Let's look at the difference between the shorter and the longer term rates then. Are you saying the reason that the shorter term rates can continue to come down or at least stay low is because it is cheaper to borrow offshore for short term? Is it as simple as that's how it works? That's
right. Our banks can continue to roll over that foreign debt on a 30 to 90 day basis. And in fact that window is actually narrowing. It's becoming shorter and shorter as we go. And because at the short term, those rates are much more governed by what the Reserve Bank governor says. So if you look at a curve, if you look at what's happening at the front of the curve, at the short term, Alan Bollard has more influence over that. At the longer end of the curve, so 3, 4, 5 years, Barack Obama has more influence over that part.
We'll come to talk about what's happening in America at the moment. However, is it likely that the pressures will come to bear in due course on the short-term mortgage rates as well, and how much of a window is there left on those rates staying low?
I don't think that there's much more for those rates to fall. Currently the floating rate is around about 6.4 to 6%, depending on which bank you're with. I can't see that falling much more than another 0.25% or so, given the Reserve Bank is almost at the bottom. And that means that for the foreseeable future, and most people want to lock in for a year or two, those rates have pretty much bottomed out.
It's interesting that you talk about it's still being advantageous to stay on the floating rates because they are nominally lower. But surely for many people in these uncertain times, the idea of locking in a 3 or 5 year mortgage at an historically low rate would be a safe option.
Yeah, and many people are starting to look at that. But there's a lot of people who simply go for the cheapest rate right now because that's what they know. And the carrot in front of their nose, if you like, of the lowest rate right now is just too strong. It really depends on your appetite for risk. I mean, how lucky do you feel about how things will
with
go?
Your house?
That's right. In the next 4 or 5 years.
I was just looking at some figures. It's astonishing. In February 2008, I think floating rates were at 10%, Bernard.
That's right.
Have we got short memories, perhaps?
That's right. We've had a big fall. Now the question is, how long do you think it's going to stay low? And you're right. For many people, they do have longer memories and will know that floating rates can get up to 10%. So if you can get a 3 or 4 year rate that's at 6.5%, that looks pretty good.
What impact does the behaviour of consumers have on these banks? For example, we're hearing now that they're under pressure, that as people start to get back into the housing market, there's pressure and demand for lending, obviously. If people start to change their behaviour en masse as they're trying to read the same entrails that we are this morning, does that in itself have an impact on these rates?
It does.